Okay, this is technical analysis on the S&P 500, also known as the SPY. Sorry about that. Also known as the market. As you know, your stocks, whatever you own, unless you own some very unknown pennies like I do, they have a correlation to the market. If the market's up, your stocks are up. If the market's down, your stocks are down. Normally. Lately, the market's been up and your stocks have been down. I don't know what to tell you. Probably look at them volume bars lately. They're low. So I guess most of the move in the market has been short covering. So if you've been in stuff that's heavily shorted, you have been up the last few weeks. If you are in stuff that hasn't been heavily shorted, you might be down the last few weeks while the market's been up. That's just how it goes. You'll bounce back. Anyway, this is called the measured move. It goes back to Dow theory, which means it goes back to the 20s or earlier. This is from the book. I'll cite my source, Technical Analysis of the Financial Markets by John J. Murphy. And this is called the measured move. And the measured move started in November, I would say. That large gap up when the vaccine news came out. I'm going to be honest here. I was short in everything at that point. I lost about half my money before the market even opened. You guys probably remember that huge gap up pre-market. It was before the market even opened. And when the market opened, TD Ameritrade froze up so no one could sell the peak. You remember that day. It was horrible for longs. It was worse for shorts. Anyway, that's beside the point. So I'm going to say that's the beginning of the move that we're talking about here is around 350. The second arrow shows the first gap up, the first big gap. That happened at 400. That happened the end of March. Probably a huge gap, and probably your stocks didn't go up. It was probably frustrating. But anyway, that would mark the midpoint of the move. The next big gap will be the exhaustion gap, and that'll be at the end of this move. And that'll mark the beginning of the pullback. And then you know how it goes. The market will pull back, and then it'll recover again, as it has since 2009, or it will continue to crash like 1929. We don't know at this point. But that big exhaustion gap in the end of this move, according to the measured move, will be around 450, 440 conservatively. If you're a weak sister and you get scared easy, the 440 would be the point that you would dump. If you got balls of steel, 450 would be the point that you dump. Anyway, I know most of you guys are buying calls over here, so continue to buy calls till 440 or 450. You're going to get paid.